Economic downturns and turbulent markets can make people nervous. It's natural. That said, recognize these events as normal, although undesirable, part of the economic and investment cycle. With that in mind, let's chat about the tips for investors like yourself during unpredictable times. Number one, don't panic. Some people may be tempted to bail out of their stock investments if markets are having a rough ride. Selling solely because the stock market tumbles could be the worst thing for your investment portfolio. So what should you do? Well, consider this: stay invested. If you're investing for a long-term goal, like retirement, that doesn't start for another decade and could last 2 or 3 decades, you as an investor have time to ride out these short market cycles. As the table shows, missing some of the best days in the market can significantly reduce your gains over the years. An investor who stayed fully invested over the past 15 years would have earned $19,215 more than someone who missed just the best 10 days in the market over that same 15-year period. If the stock market posted gains and losses every other year, imagine what you would lose by selling after a dip. Where would you put your money? A money market account has an average return of less than 1%. I know that's hard to believe in the current environment, but over the past 15 years, it has an average return of less than 1%. And that won't even keep up with inflation. If you take the same 15-year period for inflation, inflation averaged 2.3%. Number 3, keep a long-term perspective. Remember, folks, as the saying goes, it's not about timing the market, it's all about time in the market. It's easiest to stay the course if you focus on major life goals and not the market's day-to-day, month-to-month, or even quarter-to-quarter movements. Look at your quarterly account statements and stay on top of major current financial events and plan to do a thorough review of your investments. That is asset allocation, investment performance, and progress towards those long-term goals at least annually. Number 4, dollar cost averaging. One of my favorites. One of the most effective approaches to investing is dollar cost averaging. You simply commit to investing the same dollar amount on a regular basis. When the price of shares in a stock or investment increase, you buy fewer shares. When the price of a stock or investment decreases, you buy more shares. Dollar cost averaging is a great way to develop a disciplined investing habit. Additionally, it can lead to less stress during times of market volatility, as your overall costs could be lower if you are engaging in dollar cost averaging. Number 5, maintain a diversified portfolio. Diversification seeks to lower your risk because historically not all parts of the market move in the same direction over the same time. Losses in one area may be balanced out by gains in other areas. This is simply called assets that have negative correlation. They move in opposites. Number 6, know your risk tolerance. If you find that investments like stocks are too risky and, quite frankly, the risk keeps you up all night, think about different investment options. It's important to recognize that at the end of the day, your overall well-being, both emotionally and financially, is making up the bigger picture for your long-term goals. Guys, thank you so much for watching this video. My name is Zach Carruthers. I'm a financial advisor, and my goal is to empower individuals like yourself to embrace financial confidence and unlock the path to a life truly well lived. Have a wonderful rest of your day.